Margaret collects rent checks. David owns index funds. They both retired last year. They both think the other one made a mistake. They both think the other one is going to run out of money before they run out of years. And when you actually run the full numbers, not just year one, not just the monthly cash flow, but the real numbers across 30 years of retirement, one of them is right, and the gap is not small. But here's the part nobody tells you up front. It depends almost entirely on something that has nothing to do with returns and almost everything to do with something called the sequence of those returns. And if you don't know what that means yet, by the end of this video, it will be the most important thing you've heard about retirement in years. Let's keep this fair. Margaret and David are both 65. They both just retired. They both spent 35 years working, and they both saved well. And they both walked into retirement with the same number, $1 million. Same amount, same starting line, the only difference is what they're holding. Margaret owns 3 rental properties, free and clear, no mortgage, no debt. Total market value, $1 million. She earns roughly $4,800 a month in rent before expenses. Her tenants pay her. She doesn't work anymore, but the money still shows up. David has $1 million sitting in a total market index fund. No properties, no tenants, no late night phone calls. He logs into his account every morning with a cup of coffee, checks the number, and goes back to reading the newspaper. Simple, clean, automatic. On day one, both of them feel like they made the right call. But only one of them has actually done the math past month 1. For the first few years, Margaret is living the dream she spent decades building. The rent hits her bank account on the first of every month. She doesn't have to sell anything. She doesn't have to ask for anything. The money just comes. When her daughter asks how retirement is going, Margaret says, "The tenants are paying my bills," and she means it literally. David's experience is different. His $1 million is sitting in the market, growing, or at least that's the plan. Year 1, he's up. Year 2, he's up a little more. His advisor tells him to withdraw $40,000 a year, which is the 4% rule, which sounds perfectly reasonable. That's $3,333 a month. Not as visible as a rent check, not as tangible, but it's there. Here's what David doesn't realize yet. The sequence in which the market delivers those returns is going to matter more than the returns themselves. Not a little more, enormously more. And the way it can go wrong is something that almost no one explains clearly enough to retirees before it's too late. Let's look at the numbers through year 3. Margaret has collected roughly $172,800 in rent. That sounds like a lot, but subtract property taxes, about $9,000 across all 3 properties, subtract insurance, another $6,000, subtract 1 month of vacancy when a tenant left and she had to repaint and relist, $4,800 in lost rent plus $14 in costs. Subtract 1 HVAC replacement that she didn't see coming, $7,200, and a leaking roof on the second property, $4,500. Her actual net cash, the money she spent or saved after 3 years, is closer to $140,000. Not the $172,800 on paper. Real money is always less than paper money. That's the first lesson. David has been pulling $40,000 a year from his index fund. Year 1, the market is up. Year 2, it's up again. His portfolio is at $1,027,000 by the end of year 3, despite withdrawals. He looks like he's winning. He feels like he's winning. And in those first 3 years, he actually is. But year 3 is where the story takes its first turn. Because what no financial commercial will ever tell you, what no salesman will put on the card and slide across the desk, is that in retirement, it is not about the average return. It is about when the bad years happen. Think about this carefully. If the market drops 30% in year 1 of your retirement, your $1 million becomes $700,000, and now you still need to pull $40,000 to live on, which means you're pulling not 4% of your original balance, you're pulling 5.7% of what's left. The math has already shifted against you, permanently. The following year, even if the market bounces back 30%, it's bouncing back on $660,000, not on $1 million. You've locked in real losses that no recovery can fully reverse. This is what researchers call sequence of returns risk, and it is the single biggest financial threat to anyone who retires with a portfolio of stocks and starts withdrawing from it. Academic studies are clear on this. One researcher tracked two investors who both retired with the same $1 million, both earning the same average market return over 25 years. The only difference was timing. The one who retired just before a major crash, their portfolio was empty by year 17. The one who retired into a strong market, they finished with $351,000 still in the account. Same average returns, same withdrawal rate, completely different outcomes. The sequence destroyed one of them. David doesn't know this yet. In year 3, everything looks fine, but year 4 is coming. Now let's look at Margaret's situation in year 4. The market has a rough stretch. David watches his account drop from $1,027,000 to $1,080,000 in about 14 months. He still needs to live. He pulls his $40,000. He tries to hold steady. His advisor says don't panic, it always comes back. And historically, that's true. But the math doesn't wait for the market to come back. Every dollar he pulls during the downturn is a dollar that can never compound again at full strength. Margaret, she doesn't feel the crash at all. Her tenants still pay rent. They don't care what the market is doing. They still need a place to live. Her cash flow drops not 30%, it drops 0%. The actual check she receives in April is the same as the check she received in January. The asset may have technically declined in value on paper, but paper losses don't pay your grocery bill, and paper losses in real estate don't stop the rent check. This is the structural advantage that no YouTube thumbnail ever shows you. Real estate, when managed correctly, generates income independent of its price. Stocks generate income by selling a piece of the asset. And when you're forced to sell during a downturn, that's not investing, that's bleeding. Let's check the scoreboard at the end of year 7. David's portfolio has recovered. The market bounced back. He's sitting at approximately $890,000, despite 7 years of $40,000 withdrawals. He's pulled $280,000 out of the portfolio. The math on why the number isn't lower is compound growth working in his favor during the recovery years. He breathes a little easier. But here's the quiet damage. During the down years, he pulled money at 5.5 to 6% of his remaining balance. The compounding advantage he would have had if those bad years had come later is gone. He can't get it back. The sequence took a piece of him that the recovery never fully returned. Margaret has collected approximately $336,000 in gross rent over 7 years. After all real costs, taxes, insurance, 3 significant repairs, 1 difficult tenant situation that cost for 6 weeks of rent plus $3,100 at legal fees, her actual net is closer to $268,000. She's also spent roughly $12,000 of her own savings on a capital expense that caught her off guard. One of her properties needed a full electrical panel replacement, but her properties are still worth approximately $1.1 million. She owns them outright, and every single month, the checks keep coming. At year 7, David has $890,000 in paper wealth. Margaret has $1.1 million in hard assets and $268,000 in real cash collected. The gap has opened. Quietly, gradually, the way gaps always open in retirement, and it's now running clearly in Margaret's favor. The monthly check is the number you see. Whether it's a dividend statement or a rent deposit, you see the number. What you don't see is the list of what that number cost to produce and what vulnerabilities are hidden inside it. For David, the vulnerability is invisible. It has no name on the bill. It's called timing. If his decade had started differently, if the rough years had come at the beginning instead of the middle, his story would be a completely different story. He got lucky. Most people don't know they got lucky until years later when they meet someone else who didn't. For Margaret, the vulnerabilities are visible and they are real. Capital expenditures, the slow accumulation of deferred costs and aging buildings. Roofs last 20 to 25 years, HVAC systems last 15 to 20, water heaters give you 10 to 12 if you're lucky. These aren't surprises, they're scheduled, but most investors don't schedule for them. If you own a property worth $300,000 and aren't setting aside at least $250 a month in a capital reserve account, you're not running a retirement income stream, you're running on luck. And luck in retirement planning should never be in the same sentence. Vacancy. The average rental property sits empty for 1 month per year. That's 12 months of income lost across 12 years. Plan for it, budget for it, add it to the math before you call yourself cash flow positive. Difficult tenants. One bad tenant, someone who understands the eviction process better than you do, can cost you 3 to 6 months of lost rent plus legal fees. That single event can erase a full year of profit. It doesn't happen to everyone, but it happens often enough that anyone who says it never happens is either lying or has never owned rental property for more than 5 years. None of these show up in the $4,800 a month, but they show up eventually. Everything does. If I only showed you the problems with real estate, I wouldn't be giving you the complete picture. Index funds have real retirement risks that get minimized, glossed over, or conveniently left out of the conversation. The sequence problem I described isn't theoretical. It has happened multiple times in the recorded history of markets. The retiree who started drawing from their portfolio in 2000, right before the dot-com collapse, followed by 9/11, followed by the recovery, followed immediately by 2008, faced a sequence that the 4% rule was simply not designed for. Not every retiree who followed that guideline survived it financially. And the 4% rule itself was built on American market history during one of the most exceptional periods of economic expansion any country has ever experienced. If you're not retiring in America, or if the next 30 years look different from the last 30, and they might, the rule may not hold. There's no cash flow. When you own index funds, you do not receive a monthly paycheck. You receive dividends, about 1.3% on a broad market fund. On $1 million, that's roughly $13,000 a year. If you need more than that to live on, you're selling. And selling in a down market is exactly the scenario that destroys retirement portfolios. There's no control. You cannot call Apple and ask them to perform better this quarter because your rent is due. You cannot negotiate your way through a market correction. You sit and you wait and you hope the sequence is kind to you. For the person who spent 35 years building a business, managing employees, solving problems, sitting and waiting doesn't come naturally, and the temptation to do something, to sell, to shift, to react, has destroyed more retirement portfolios than any market crash in history. Here is where the full story comes together. Over 20 years of retirement, David has withdrawn $800,000 from his portfolio. If the sequence was reasonably kind to him, if the bad years stayed away from the first decade, his portfolio could still be worth $900,000 to $1.1 million, depending on market timing. If the sequence was not kind, if a significant crash happened in years 2 through 5, his portfolio might be anywhere from $400,000 to $600,000. The range is enormous. The uncertainty is real. Margaret has collected, after all real costs, all vacancies, all capital expenses, all property management stress and paperwork, somewhere between $380,000 and $440,000 in actual net income over 20 years. Her properties, after 2 decades of modest appreciation, are now worth approximately $1.4 million to $1.6 million. She owns them outright. They are still generating income, and she can decide at any point to sell one and convert it to whatever she needs. But here's the thing nobody tracks. Margaret also spent more time, more energy, more nights thinking about tenant issues, more weekends coordinating repairs, more hours on the phone with insurance companies. That labor has a value. And if you're 70 years old, that value is not just money, it's years. This is the calculation that balance sheets cannot capture. The best retirement plan is not the one that produces the most wealth. It is the one that produces enough wealth with the least damage to the years you have left. There's specific situations where the math genuinely favors index funds in retirement. If you have no interest in managing properties, none, then owning rental real estate is not passive income. It is a part-time job with unpredictable hours and no guaranteed pay. And doing a job you resent in retirement is not a retirement strategy. It's a trap with good-looking cash flow numbers. If you are in a high-cost real estate market where rent-to-price ratios are deeply unfavorable, where a property worth $800,000 rents for $2,200 a month, the numbers simply don't work for new acquisitions. You'd be better positioned in index funds with a careful withdrawal strategy. If your index fund portfolio is large enough, and if you apply dynamic withdrawal strategies, reducing spending during down markets, increasing during strong ones, the sequence risk becomes far more manageable. The research shows that someone who pulls back even modestly during bad years dramatically extends the life of their portfolio. The rigid 4% rule is only dangerous when it's followed rigidly. Flexibility is the investor's real best friend. And if your financial situation includes significant tax-advantaged accounts, Roth IRAs, for example, where growth and withdrawals are entirely tax-free, the index fund strategy becomes even more powerful. Decades of compound growth accessed completely tax-free is one of the most underestimated retirement advantages available to any American retiree. There are also specific situations where real estate becomes the superior choice, and some of them may describe your exact situation. If your properties are paid off and generating clean cash flow, the sequence risk argument disappears almost entirely. You are not selling anything. You are not liquidating anything. The market can fall 40% and your tenants still owe you rent on the first of the month. That structural immunity to market timing is not an abstract advantage. For a 68-year-old watching their friends panic about their portfolios, it is sanity. If you understand the depreciation tax shelter, and most real estate investors don't fully understand it, real estate is one of the most tax-advantaged income streams legally available. You can collect $4,000 a month in real cash flow and report very little of it as taxable income. The IRS allows you to deduct the theoretical decline in value of your building, even if the building is actually appreciating in value. That is legal, that is real, and that is something no index fund can replicate. If you have properties in markets with strong rental demand and favorable rent-to-price ratios, smaller cities, growing suburbs, areas with limited housing supply and expanding population, the cash flow advantage compounds over time in ways that paper portfolios cannot. And if leaving something physical and tangible to your children and grandchildren matters to you, and for many retirees it does, real estate carries generational advantages that the tax code treats very favorably. When you inherit a property, its cost basis resets to current market value. Decades of capital gains gone. That is not a small thing for families thinking long-term. Let's talk about the retirement nobody plans for, the one that starts great and then gets hard. Most retirement plans are built on averages, average returns, average lifespans, average health costs. But retirement is not lived in averages, it is lived in specifics. It is lived in the year the market dropped 34% in a single month, March 2020. It is lived in the year your largest tenant lost his job and stopped paying rent for 4 months while you waited for the eviction to process. It is lived in the year your own health changed and the property that used to feel manageable suddenly felt like a burden. The best retirement plan is the one that survives the specific, not just the average. And here's the uncomfortable answer that data supports, that researchers support, and that most people in retirement eventually discover on their own. Neither asset class alone is the complete answer. The most resilient retirement portfolios combine both, not because diversification is a buzzword, but because the structural weaknesses of each cancel each other out when they're paired intelligently. Index funds give you liquidity. Real estate gives you stable income. Index funds give you global diversification. Real estate gives you inflation protection. Index funds are simple to manage when you're 80. Real estate is hard to manage when you're 80. Index funds are vulnerable to sequence risk. Real estate is immune to it until it isn't, because markets can and do affect rental income eventually, just more slowly. The retiree who has 3 paid-off properties generating $4,000 in clean monthly cash flow plus a $400,000 index fund that she never has to touch unless the roof falls in, that retiree is not choosing between the two strategies. She is using each one to protect against what the other one can't defend against. That's not exciting. It doesn't make a sharp YouTube headline. It doesn't win arguments at dinner parties, but it's the strategy that survives 30 years of everything markets and life can throw at you. Margaret and David both walked into retirement thinking they had figured it out. Margaret thought owning hard assets and collecting rent was the only real way to have income without working. David thought a diversified portfolio and a simple withdrawal strategy was the only rational, evidence-based approach. Neither of them was wrong. Both of them were incomplete. The real trap in retirement planning is not real estate. It is not index funds. It is making a decision about how you will live for the next 30 years based on what felt smart at 65, without stress testing it against what happens if the bad years come early, if the tenant stops paying, if the roof goes in the same year the market drops, if you live to 91 and the math you plans to 85 stops working. The question is not which asset pays more in retirement. Both of them can. The question is which one pays more in your retirement, given your health, your temperament, your family situation, your tax bracket, and your genuine willingness to deal with whatever that asset demands from you. Because every asset demands something. Index funds demand that you do nothing when the market drops 30% and everything in your body is screaming at you to do something. Real estate demands that you deal with real problems in real buildings with real people inside them, usually when you'd rather be somewhere else. Know what you're signing up for before you sign, because the fine print in retirement doesn't come on a piece of paper. It comes on a Tuesday morning 5 years in when the sequence was bad or the tenant was worse and the plan you made at 65 meets the life you're actually living. Run the full numbers. Not just the monthly check, not just the average return. Run the bad year scenario. Run the sequence goes wrong scenario. Run what happens if your health changes and you can no longer manage the property. Run what happens if you need liquidity in a year the market is down. And then ask yourself one question. Does my plan survive all of that? Because that's the only plan worth having. And that's the only number that matters. Next time, if you're about to put that index fund money into an annuity instead, because someone told you it's guaranteed income and that sounds better than all of this, the math on that one might surprise you more than anything we talked about today.